Dr. Aurodeep Nandi, India Economist and Vice President Nomura joins us. Mr. Nandi, good morning. Thank you for joining us. What do you expect tomorrow? Hawkish or a very hawkish governor?
Well, I mean, look, the RBI is in the business of doing nothing and yet doing a lot, right? So I think in terms of rates and in terms of stance, there doesn't seem to be much impetus to go either ways. Now, as your colleague mentioned, the Q2 GDP number is higher, much higher than what market was expecting. Mind you, RBI's own official forecast was 6.5% or so there. So the overall annual GDP growth of 6.5% forecast might be even upped to around 6.7% or so. So, is there a need for the RBI to cut at this point? Certainly not, because growth by RBI's own estimates remain strong. On the inflation side, there are upside risks, right? So yes, we've had a better inflation number, but hey, onion prices are picking up, tomato prices are picking up, and as long as the headline inflation remains high, and the governor has been very emphatic about it, that look, my target is not 5%, it is actually 4%. So the next print, in fact, could be as high as around 5.8% or so. So for the RBI, those upside risks remain. So on the inflation front, I think they're going to be very cautious. So on the rate side, we stay where we are. On the stance, because the withdrawal of accommodation stance has been linked to their vigil on inflation. Given that the vigil is still there, the withdrawal of accommodation stance still remains. Now, the point that you are making, which is very important in all of this, is what's the body language going to be, especially on liquidity? Because a lot of the tightening seems to be delivered through that route. And there, I think, the last policy, the governor announced possible OMO sales, and that sort of set the cat among the pigeons in the bond market. And then over the past couple of months, we've actually not seen a liquidity situation that has warranted that intervention from the RBI. So one of the things that markets are going to be watching out really carefully is the language around liquidity. So I really don't think that the governor would give a dovish bias to any of this. He would like to remain hawkish. He would like to say that, look, I am still looking at tight liquidity. To a great extent, I think it would be continuing with the kind of hawkishness that we've seen in the past couple of meetings, despite a pause in rates.
I wanted to also understand from you then, Aurodeep, what would be the major risk that you believe that would emanate for the Indian economy? Would it largely be, global, emanating from the global markets, or do you think perhaps a moderation in consumption or inflationary concerns back home would be the key risk?
I mean, if you unravel the otherwise very strong GDP number, you'll realize that there's a lot of it is being driven by the government, right? Government on the investment side, government on the consumption side. And again, we've been having a real estate boom, so we've been seeing construction doing really well. But once you take these out, and then you start wondering, well, what is really the growth driver? And there you find it unnerving, because consumption growth has actually already slowed quite a lot. It's been 6% in Q1 FY24. It sort of from around 6%, it came down to around 3%. So the concern that we have is that, look, growth momentum undeniably at this point remains strong, right? So you will see sort of growth numbers, the headline numbers doing well. But as we approach election cycle, the focus on public capex is likely to wane, also from a fiscal consolidation perspective. And private investments, it is happening in pockets, but probably not as widespread to drive growth on its own. And on the consumption side, we see a lot of K-shaped kind of recovery, urban demand doing well, rural not doing well. And the overall consumption growth story, how much that will be to sustain growth, I think is the bigger question. And then our base call is that we see a recession in the US in the second half of next year. And obviously, timing recessions is always very tricky. But the point is that, interest rates across developed markets have been yanked up this year. And the impact of that on growth, on inflation, on consumer finances is likely to show up next year. And when that happens, possibly in the second half, on the growth side also, countries like India will face headwinds. By the way, we are already seeing this, say, for IT companies, which have already started reducing their headcount in anticipation of a global slowdown. So near-term momentum strong. I think looking forward to next year, we have a more bearish outlook. So we have 5.6% for FY25, down from 6.7% in FY24 as far as GDP growth is concerned.
But Aurodeep, the intriguing thing is that irrespective of all these growth concerns, not just with India, but some of the global economies as well, and where next year is going to head, liquidity is a flush and, sloshing around across asset classes. You think the RBI is also going to take some cognizance on liquidity control measures?
I mean, look, for the RBI, the key concern is financial conditions should be tight in order to ensure that the focus remains on inflation, the focus remains on supply side inflation to not become demand side inflation, which is something which they have actually admirably done so far. So, core inflation remains low. The second round effects have been sort of very capped. Inflation expectations are low. And then, of course, we've got the bond inflation coming up next year. So again, we expect that flows come in anticipation to it, and then of course once it kicks in, actual flows also start coming in. And so for the RBI, of course, a big concern is the fact that these flows are going to come in. How do you manage the implication on domestic and on exchange rate? So that is certainly on their radar, and I think the RBI is going to be really cautious on the liquidity front.
All right. What about your outlook then in terms of the impact of the elections on the overall monetary policy decisions and on the macroeconomic backdrop as well? How do you see it impacting it?
I mean, on monetary policy, I think monetary policy at this point will be driven a lot by by domestic macro factors. So growth and inflation, and if growth starts, the growth signals start weakening come next year, then and inflation remains anchored, then the RBI could very well move into the a rate cut mode. Our expectation of the first rate cut is from August onwards. As far as elections is concerned, I mean, obviously, look, this is the political battle royale as far as macros are concerned. The BJP win in state elections has been perceived by markets as an indication of strong popularity of the ruling party. I think the way to look at it is the next 3-4 months is going to be important. From two perspectives. One is that in the run-up to elections, you might see an increase in, just general consumption, but also a reduction, as I mentioned earlier, in terms of public capex. Even private capex might wait for the outcome of the elections before committing to new investments. So, we might see some of that sort of slow down now and then pick up once the political scene becomes clearer. I mean, if we see a return of the current government with this current level of majority, of course, then the expectation broadly would be that the reform momentum continues, that the focus on fiscal consolidation continues. But again, I think the key thing is in the run-up to this, what happens on fisc? Is it that the government, and is there going to be too much of a risk from competitive populism? I think those are the things that people are going to watch out for now. And then, of course, depending on what the elections throw out, the macro scenario might change.
Good to have you on board. Thanks very much for putting all of those details into perspective. Tell you what,